Okay, grab my little pen here and off to the races. So in terms of long-term financing, where do companies get money over the long, when they need money for the long term? Well, the primary way in which all companies start is the owners put money into the business, right? So if you were thinking of starting a small company yourself, you would need to have some money to put into that company so you can start up your business, right? Well, for a corporation sells shares of ownership, and that is what stock is. So the word stock really is shares of ownership, and that is about the corporate form of business. There's no stock in a sole proprietorship, and there's no stock in a partnership. Stock simply represents shares of ownership in a corporation. And the entire stock market, a lot of people hear about the stock market a lot. Well, the stock market is where companies go to raise money by selling shares of ownership, in this case to the public. If you can buy shares of ownership in a company, that means the company is a public corporation. They've opened up the ownership to the public. So anyone in the public can become an owner by purchasing shares of stock. And that's what the stock markets really function as a marketplace where owners can buy and sell their shares of stock. Once you own stock, shares of ownership, you might want to sell them at one point. Well, where do you sell them? That's what the stock market does. That's the function. And so when a company wants, but this again, before I get into this a little bit more detail, most corporations are actually private, which means that you and I cannot purchase shares of ownership in a private company, unless, of course, we can do that. We have a deal with the owner. You'll see a lot of that on, what's the name of the show? Shark Tank. You'll see that on Shark Tank and some other types of things. Those are private corporations, and only certain private individuals have access to shares of ownership. So you and I will never, ever, ever, in many cases, have any idea of what's going on in a private corporation because the information is strictly for the owners. And you and I, as a member of the public, really don't have any right to that information. It's private information. But that's not true for a public company. That's why we know so much about, Facebook, Amazon, Alphabet, which is the parent company of Google. We know a lot about Tesla and all their leaders, Facebook, for example. How do we know they're so wealthy? Well, because they have to disclose. As a public company, they have to disclose how many shares of ownership they have. Even as managers, they have to disclose that information. And so we can calculate the value of what Zuckerberg is worth or Jeff Bezos is worth because that's public. We know how many shares of ownership they have in their companies, and we know what the value of those shares are because it's traded on the stock market. So we can simply do some math and figure it out. But it's different when you have a private corporation, how much they're really worth. Unless you actually see the accounting and financial records, you're guessing. You're really kind of guessing. And so that's part of a problem. But let's get back to this. When a corporation wants to raise money, one of the biggest options they have, matter of fact, one of the big advantages of being a corporation is they can sell shares of ownership to the public. The investment banking community, so all what investment banks do, I like to call them the fundraisers of American capitalism. Investment banks help corporations and governments raise money, raise money. And primarily there's two ways to raise money if you're a corporation. You can offer ownership, shares of ownership in your corporation in exchange for that money, and that's what stock is. And what you're going to see a little bit later in the slideshow is you can also ask investors for a loan. And that's what the bond market is about. That's what a bond is. So investors actually play a very important role in helping corporations raise money because they often will buy ownership stake in the company, which is stock, or they're willing to lend the company money in the form of a bond. How it all works is, again, investment banks sit down with corporations to find out how much money they need and what that would look like in terms of the process, and is that realistic? Do we have investors for that, et cetera. Once investment banks help corporations raise money, they usually do that within themselves. So Goldman Sachs or other types of large investment banks oftentimes will raise the money internally from themselves and their clients and give the corporation what they need, minus fees, of course. And the corporation has their cash. Then it comes out to us on the stock market. And so that's the initial public offering of a company. In many cases, the company already has their money because the investment bank was able to sell all those shares privately through themselves, their clients, et cetera. And so that's important. What happens when these companies, these stockholders, want to sell their common stock, their shares of stock? Well, that's when it becomes available to all of us, and that's really the purpose of the stock exchanges. The stock exchanges are actually what we call secondary markets because literally the sale of stock, the raising of the money has already happened. So the stock market is really about where, if you already have shares of stock, where can you go and sell them? Or if you're interested in buying stock in a company, where can you go to buy it? That's what the stock market functions at. But the initial go-round is really done through the investment banks overwhelmingly. Before you and I get a real chance at actually owning stock. Usually the investment banks have taken care of that already. There are lots of companies who have raised an enormous amount of money by selling stock. Okay, so these are the largest initial public offerings. So initial is the first time that they're selling stock to the public, initial public offerings. And as you see, Visa raised nearly $18 billion when it went public in 2008. Of course, the company existed prior to that. This is just offering your shares of ownership now to the public. Facebook also went public around a similar time. And when they went public, they raised over $16 billion from investors for offering shares of stock. Facebook was in existence before they went public. Facebook was a private corporation before it said, look, we're going to change our ownership from private to public, meaning we're going to go ahead and open up our shares of ownership to the public and raise money. And boy, did they ever raise money. 16 billion is quite a haul on the first day that shares went up for sale. So as you see, these are all in the billions, every single one are in the billions. Not every single time a company or corporation goes out and offers shares of stock, they're raising billions of dollars, but these companies did. And so it's important to know that's really a very good way to get money into the company to use for its operations. Normally what they want to do with that money is invest in assets that help them grow. So updating technology, perhaps buying other companies to give them a bigger market share, would be good uses, among the very good uses of that type of money being raised. They're raising money by giving up ownership in the company. Those shares of ownership are now held by people in the public. And owners have a say in how the business is run. They have a vote. And so now the rules have changed a little bit. And also because you and I are members of the public, and we can be stockholders in any of these companies, the government has some rules that they have to follow through the Securities and Exchange Commission, SEC, in which these corporations are required to report out any and all business decisions that affect their financial reporting, affect their financial status. And so you and I know a lot of what's going on in these companies because they're required to report various things. Okay. At first, actually, the story with Facebook, real quick, is that Zuckerberg wasn't really excited about going public. He really would prefer that Facebook would have stayed private because you're not subject to all these rules. Okay, there are certainly rules, but not as many. But as soon as Facebook went public, that meant that all of those decisions needed to also go public. And so that's what at first kind of scared off Zuckerberg from the idea. But of course, it worked out for him. Okay. So when a company sells shares of ownership to investors, there's no legal obligation to repay that money. Right? Investors are taking the risk of investing their money, hoping that the business does well, and that their share of ownership grows over time, becomes more profitable over time. And so that's really what's in it for investors by buying stock. They're looking at the potential that the company gets larger, the company gets more profitable, and their shares of ownership get more valuable over that time period. And so that's a real big one. That's a real big one. There's really no legal obligation to repay. So it's not a loan. That's why they call it equity. It's actual ownership in the company. It's not a loan from the stockholders. It's ownership. Okay. And that's probably one of the biggest advantages of selling stock. The company's under no legal obligation to share the profits of the company with those owners. So they're not under any legal obligation to pay a dividend. As a matter of fact, most stockholders, most owners don't want a dividend. They want the money, any profits, to be reinvested in the company so the company can grow and become more profitable. That's what they really want. So there's no legal obligation, and oftentimes, particularly for smaller companies, there's no expectation that owners say, oh, give me my money, give me a share of the profit. But as companies become well established and older, they have, in many instances, been able to not only share a portion of the profit with the owners as a dividend, but that dividend continues to increase. Some companies have long track records, 20, 30, 40, 50 years of increasing their dividends or their share of the profit that they share with the owners. And that's attractive to some investors. Okay. So the secondary market is really where you and I, as investors, can buy and sell shares of ownership. So if you own shares of stock in Facebook, for example, and you no longer want to own them. You want to sell those shares and get your cash. Well, it's the secondary markets that make that happen. The New York Stock Exchange, the NASDAQ, those are the largest secondary markets that we have in the United States. And all that happens there is investors go and sell their shares of stock to other people who want to buy them. So the only thing that happens on the stock market every day, as exciting as it might seem to some, I've worked there, is just shares of ownership being bought and sold. That's really all that's happening. Now it's being bought and sold at different prices, and in some cases that might make it exciting to watch, particularly as news comes out about certain companies. And investors react to that news by either wanting to really buy a company because it looks profitable, and so shares of this stock soar, like what happened with Tesla. Or the owners of the current shareholders hear really bad news and they want to dump. They want to get out of the company. I don't want to be an owner of this anymore. This is going down. This company is not good, but they can't find anyone to buy their. So there's no investors to buy it. So they have to keep lowering and lowering and lowering their price until someone finally buys it. A lot of those companies you'll see with large drops in their stock price during that day. So basically speaking, that's really all that the stock market is. It's a big secondary market for investors to buy and sell shares of ownership. That's it. That's all that happens there. In order to actually become part of the New York Stock Exchange or the NASDAQ, the brokers have to be a member of that exchange. And thus, they're able to execute the buy and sell orders of investors on the floor of that exchange. The New York Stock Exchange is, I would say, about 90% electronic and about 10% face-to-face. So what you see on the news, if you've ever seen pictures of the New York Stock Exchange or the floor of it, there's human beings that are involved in negotiating and getting a market for their shares of stock. But that represents a small portion of all the trades that happen. Like I said, at least 90% of everything that's happening on the New York Stock Exchange is done electronically. The NASDAQ exchange, which includes the over-the-counter market, is a network of broker-dealers who basically do everything, buy and sell shares of stock for their clients electronically. So it's 100% electronic. Computers are matching up the sale of certain shares of stock with people that want to buy those shares of stock at a certain price. And it's all done electronically. There's really no, other than people putting the information in, there's really no need for there to be a trading floor on this case. So when companies actually issue shares of ownership for sale, they're issuing common ownership. Okay, they're issuing ownership in which owners actually have a say on various issues. So owners can vote on various corporate matters. And all companies have and start with common stock. Okay, common stock is common ownership. Common ownership has rights to vote. Okay. But some companies want to raise more money, but they don't want to deal with various stockholder issues. So they might then say, okay, the next time we raise money, let's offer preferred stock instead of common stock. And what's the difference basically is it's still ownership because it's still stock, still shares of ownership. However, preferred stock holders don't have any voting rights. They cannot vote on corporate matters that are explained and given to the owners to vote on. However, in exchange for not having the voting right, they get paid a dividend first. So anytime the company decides to share their profits with the owners in the form of a dividend, it's the preferred stockholders who get the dividend first, and then whatever's left over goes to the common stockholders. And that's the thing. The problem is that only about, I'd say, 7% of companies today have preferred stock. So it's a very, very small group of companies that have preferred stock. But obviously, everybody has common stock because that's how everything starts. Okay. So common stock, common ownership, voting rights, etc. Preferred stock usually raised after a time. It's ownership, but they don't have voting rights. And if the company declares a dividend, preferred stockholders get that first. Common stockholders gets what's left. Okay. It's the only difference between the two. When a company earns money, they earn a profit. The word earnings means profit. The word earnings is the same as net income on the income statement. Oftentimes, when a company is profitable, the owners want to keep the profit in the company so they can reinvest it in more assets and sell more stuff. So how much of those profits are retained, which is kept in the company for reinvestment, is retained earnings. And again, the company has to exist for a while before it actually becomes profitable. But once it's profitable, the question is, whose profit is it? It's the owner's profit. Okay, the owners, which is the stockholders of a corporation, they own the profits of the company. So retained earnings is basically part of what we call a stockholders' equity account, because it's the profits of the corporation that are kept in. That's the word retained. That's what it means. Kept in the company. Why do they keep those profits in? They want to buy more assets and grow, sell more stuff, make more revenue, make more profits, and be bigger and bigger and bigger over time. So this is basically very important to the growth of any company. Once you start earning money, you need to retain it and reinvest it appropriately. You've probably all heard of venture capitalists, what they call angel investors, and what we call private placement. And so let's look at basically it. So venture capital is, investors who partner with corporations and receive equity in exchange for their investment. Venture capitalists, I guess, are similar to those that you would see on a Shark Tank in a way. But in a Shark Tank, those are very small individual firms that are actually doing all of that. Venture capital firms are actually larger and have an expertise in just helping companies out for a stake of ownership. So basically, they do invest money in small companies, and sometimes companies that are having a hard time, if they see they can turn it around. Actually, CNBC has another show called The Profit, and it's about a guy who goes in and actually helps turn around businesses that are struggling. And these tend to be, smaller businesses, restaurants and bars and other types of things, small manufacturers of various things. And it's actually a very interesting TV show to watch. It's called The Profit. It's on CNBC. Just like Shark Tank is on CNBC a lot. But basically, these folks really want a very large ownership stake. So an ownership position is an equity position, okay? And you'll see that actually on Shark Tank. They're really not interested in investing for 5% of the company's ownership or 10%. What's the use? It's not worth the money. It's not worth the investment. That's why on Shark Tank, every time they say, you know, I'll give you $100,000 for 30% of the company or for 50% of the company. This is typical for venture capitalists. They want a very large equity stake because they feel they're taking most of the risk. And so they want most of the return for that risk. And, you know, because they are dealing with smaller companies or struggling companies, they're often going to get a very large ownership position in the company in exchange for that investment. Okay. Venture capitalists are not usually in it for the long term. They are usually in it for shorter periods of time because they want their investment, return on their investment right away, as quickly as possible, which is usually, I would say, shorter than a few years. And then they may move on to the next opportunity. An angel investor is someone who provides financial help for folks who are starting business up, folks who consider themselves entrepreneurs that have a business idea that are just starting. And so again, there's your book actually gives a very good key term here. They're actually interested in helping a business succeed and establish themselves rather than earning that return that's so important in venture capital. Okay. And so basically speaking, that's why they have the word angel here for investors, is that they're actually trying to do a good thing, you know, by helping startups and entrepreneurs. Where venture capitalists are more, I'll take a large equity stake, and after it seems profitable, I'm going to grab my money and go. Good luck. Thanks a lot. So that's a little bit of a difference here. A private placement is just what it sounds like. It's not public. That's the stock market, right? So so a private placement, a corporation might be wanting to raise money by issuing shares of stock. And the investment broker actually can raise the money by going directly to insurance companies, pension funds, and large mutual fund companies that have a lot of money and say, look, I have this great corporation, they're raising money. I want to give you guys, you know, first shot at taking shares of stock here and helping us raise the money. And oftentimes it never reaches us as private investors or individual investors because it's sold directly to very large investment funds. Okay. So that's the equity side. So they're giving up ownership in exchange for the cash, but they don't have to pay it back. Which is awesome, right? Well, that's different than long-term debt. Long-term debt is a loan, and that means it's got to be paid back, right? So long-term debt can be very, very helpful for a corporation, depending on how it's used. So it's okay to borrow money to buy certain assets, but you have to figure out, well, is it going to be in the owner's best interest? And how much leverage is the use of debt, how much debt you want to use to get things done. How much is too much leverage? How much leverage is just enough where we're making a lot of money? It's a good loan because we're actually making money on that. What we invested in it is turning out to be better than we wanted. The company's profitable, so our owners are happy, blah, 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 blah. Corporations look at leverage in that way. Okay, it is long-term, and there has to be a return to the owners by borrowing the money. Okay, small businesses are in a different, you know, very, very different situation because for small businesses, it's going to be almost solely related to bank loans or other organizations that help small businesses get long-term loans. Large corporations have more options. They can also get loans from banks. and others that lend money. But they can actually go right to investors and say, look, we're looking to borrow money for the next 10 years. And this is what a bond is. Okay. The word issuing means selling bond, like selling stock. In this case, a bond is basically a loan from investors. That's the function of the bond market. The bond market's function is to provide loans to investors. Investors to lend their money to corporations. Sorry, I think I need another hit of my coffee. Okay, yeah, I'm better now. I'm not going to go over this because we're not going to be doing any analysis here. But what this is saying is if the company borrowed money rather than ask the owners to put more money in, what would actually be better for the owners? Well, here, if they borrowed some money, they would, in this example, they would actually have a return on the equity of 17%, whereas if they asked the owners to put more money in, the return would only be 15.8%. They're both awesome returns in terms of getting return on something, but obviously this is bigger. So the better choice is to add a little bit more debt because the owners are going to get a better return on that. So they'll figure this out. And actually, if you study, if you go more deeply into accounting, or if you study finance, like I did, you'll be getting into those in more detail and understanding the benefits of borrowing versus, is it worth borrowing versus asking the owners to put more money in. Both are options when you raise money long term. So in terms of long-term loans that corporations usually have, I mean, they can basically get a loan from almost anywhere. There's lots of lenders out there. Banks are not the only ones in the game, but they are traditionally what we think about when we look for loans. But you can get loans from other corporations and so forth. And but loans are basically promissory notes. You're going to repay the loan at some point in the future. And not only that, you're also going to be paying interest on that loan. And so not only do you have to pay it back in the future over the course of maybe 5, 10, 15, 20 years, but you also have to pay interest at a regular time as well, because that's the cost of borrowing the money. Okay. So interest rates are very low right now. So there's a lot of corporate borrowing going on. There's certainly a ton of government borrowing going on because they're basically borrowing money at close to 0%. So it doesn't matter that the Fed, for example, the national debt is, I don't know, 20 trillion, 22 trillion. It doesn't matter because it's basically all financed close to zero. So when you don't have to pay the loan for a while, it doesn't matter. If the interest is zero, you're not really paying too much. So, the interest rate is the cost of borrowing. It's the price of a loan. So corporations that are large or in good positions are actually getting really good interest rates right now. So they're borrowing money makes a lot of sense. If there's a stated payoff, good return on what they're going to use it for. But we also live in a COVID world, so the plans, I'm sure, at many business organizations have changed in a way. They've been tweaked to say how could we be profitable and still grow in the current environment. That may not change for a while. So I'm sure their plans have been tweaked a bit. Some companies obviously have been hurt greatly by this. So Disney laid off 28,000 people, they announced earlier this week. And so that's a lot of people that are going to get hurt from that. So business obviously isn't great at places like Disney. So everyone's going to be affected very differently by this. And Disney certainly has loans that they want to make sure they're able to pay back and make sure their owners are okay with all of that. Some lenders require what we call collateral, okay? And collateral is basically an asset that the company pledges in exchange for the loan. Let's take this personally speaking. You may have a car loan. If you bought a car and you have a car loan, part of the lending agreement that you've agreed to in the contract is that if you fail to pay the lender over a period of time, usually they give you a couple of months to try to catch up on payments, but if you're not paying your car loan, 2, 3, 4, 5 months down the road, you've given them a right to take the car back. That's because the car is the collateral. That's the asset that's backing the loan. And a lot of people don't realize that there's certain terms of those loan agreements that you're agreeing to. So a car loan automatically has terms in it that the car is the collateral. And if you can't pay your car loan back, you've given them the right to take the car. I know it's called repossession. A lot of people hate it, but that's part of the contract that they signed. Getting a house is the same way. If you agree to a mortgage on your home, when you buy a home, you got a loan called a mortgage. That's part of that agreement too. If you fail to pay your mortgage on a regular, that usually they give you a few months, they give you warnings, they ask you to catch up. They really do give you some time. You've given the bank the right to take the house back away from you. And that's what a foreclosure is. It's the same type of thing. But all these long-term loans, a lot of lenders will ask for collateral. They'll say, look, we need assets to back up. We're happy to give you the loan, but we want to make sure this loan gets paid back. And here is where the collateral issue comes in. So that's important to know. And that does happen in the corporate world as well. There are lots of loans that are backed by collateral. And a lot of corporations have plenty of collateral. They have buildings, they have equipment and machinery that makes it reasonable collateral for any loan. But when they go ahead and ask investors for a loan, that's what bonds are, oftentimes it doesn't come with collateral. Most of the time, it doesn't come with collateral, in fact. And so why would an investor be willing to give a corporation a loan if in many instances there's no collateral, there's no guarantee that they're going to get paid back? Well, that's because corporations actually have credit ratings. Just like you and I have credit scores. A credit score is used to see how likely we are to pay back a loan. So a lender looks at the credit score and says, okay, this person is more likely to pay back the loan, so I'm willing to give them a loan at a lower interest rate. If you're much less likely to pay back that loan, you'll have a lower credit score, right? Which means you might have had problems paying back loans in the past. You might not have kept your word. So it doesn't mean you can't get a loan, but you're going to be charged a nominal egg for that loan. Very, very high interest rates. Well, guess what? Investors think the same way. They're more comfortable giving loans. Investors are more comfortable giving loans to corporations that are healthy, that have a track record of managing their money well and paying back their loans on time. Those corporations will have a very high credit rating. But you also have a lot of corporations who have had problems paying bills, paying things back. It doesn't mean that they cannot ask investors for loans, but investors will look at their credit rating and decide, okay, this is a risky loan. If I lend my money to this corporation by buying its bond, buying one of their bonds or more than one of their bonds, I'm taking a bigger risk. The only way I'm willing to take that big risk is if they give me a big return. So I'm going to add the interest rates kind of go up. And so that's basically how investors size up giving a loan to a corporation. Corporations have credit ratings, just like you and I have credit scores. Most bonds or corporate bonds are for long periods of time. 10 to 20 years is pretty common. On the day that, and so what happens is you are not going to, if you buy a bond, if you lend a corporation money, say, and most bonds are $1,000 each. So one bond is basically $1,000 loan. So let's say you buy one bond for $1,000. You've lent your money to the company. The company is going to pay you interest until they actually give you $1,000 back. The actual loan is repaid on something called the maturity date. Okay, that's when they actually have to repay. So you're going to get interest until you get your money back at the very end when it's matured. That's how bonds work. Okay, I've already kind of gone over this. High quality corporate bonds are less risky, so it's easier for those corporations to raise money. But there are companies that aren't as high quality, you can say. We can call them more speculative. It's a bigger risk to lend them money, but doesn't mean that investors won't do it. They just want a higher interest rate. That's all. And we actually used to call them junk bonds. Now they're actually called high yield bonds. But it's basically a risky loan that an investor made to a corporation. Most bonds on the bond market that corporations raise money for are called debentures. And debentures is basically a bond that is only backed by the company's reputation. So like I said, if the company has a reputation of, over the many years, being very responsible financially, always paying back their loans, they're going to have a very high credit rating. And so they can issue as many debentures as they want because they're almost always good for it. Okay. But then again, there are a lot of companies that want to raise money by debenture bonds that are risky. And investors are willing to lend to risky companies. They just want a higher rate of return on that loan. They want a higher interest rate to compensate for the risk that they're taking. There are some bonds that are backed by assets, like a mortgage bond. Usually a mortgage is on a piece of property, building, things like this. So it's usually that, in this case, the building is collateral for the bond, for the loan. And there are some interesting features to some bonds, and this is one of them. There's something called a convertible bond. It's not like the bond top goes down, so you can enjoy the nice weather. A convertible bond basically is, investors started by lending money to the corporation in exchange for this bond. Well, a convertible bond means that at some point in time, you can actually exchange the bond for shares of stock. It's usually predetermined, so it's easier to do the math whether it's worth your while or not to convert from being a bondholder to being a stockholder. That's basically what a convertible bond does. It gives you, as the lender, the option to get paid back in stock rather than get paid back in cash. It's basically how convertible bonds work. So it's an interesting feature of a bond, but it's still a bond. It still starts off as a loan from investors. It's just that this loan can be paid back with shares of stock instead of cash. And it's totally at the lender's option. You don't have to do it, but it's an option. So it's a very interesting feature of a bond. All bonds are legal documents. It's a contract. It's a contract. And so that legal document that gives all the details of the loan is something called an indenture. Okay. So before people invest or lend their money, they should be reading this indenture. They should be reading all that legal document that explains everything that you need to know about the company before you decide to lend company your money. There's no indenture for the United States government because they can print money. So they don't have to explain to you how you're going to get paid back. They've got the printing presses. Obviously, everyone else, state governments, corporations, others, they don't have that privilege of printing money. So they have to put together this legal document explaining all the details and conditions of what you're agreeing to in lending the money and how you're going to get paid back, etc. Some corporations want to make sure that investors, lenders particularly, are okay with the loan by promising them a few things. One is that, look, we're definitely going to have the money to pay you back because we have set this up as something called a serial bond. Now, a serial bond is not like a serial killer. A serial bond basically is, look, it's a loan, and it might be a big loan, $100 million, $1 billion, or more. It might be a big loan, but guess what? We're not going to pay it back all at the same time because that's what people worry about with bonds. Well, hang on, you're borrowing $1 billion now, and it's due on a certain day. How are you going to come up with $1 billion to pay us back? That's what investors want to know. So what they've done as part of the document is say, look, we are going to pay all these back at different maturity dates. So in essence, we're going to be paying a little bit now, a little bit now, a little bit now on these dates. So whatever your date is of your loan, that's when you're going to get paid. And because we're staggering the payment, we can afford it. So you don't have to worry about not getting your money. We're going to get that done. Okay. Because again, how bonds work, how these loans work, is you have to pay it back at all on the due date. You're paying interest for the time that you have the loan. But when it's due, that means the whole thing is due. You're paying back the entire loan. And you see that, frankly, if anyone pays attention to the political theater going on here, and it really is theater. That's one of the questions of that $421 million that the president owes in the next 4 years. That's a lump sum payment that in most cases, if it's a traditional business loan bond of sorts, how do you grab all that money all at once and pay it back? The good news is, of course, for the business and what the government's been doing is they simply pay it back by getting another loan. So it doesn't mean that it's terrible, but you keep your promise to pay it back on a certain date, even if you have to pay it back by taking out another loan. And it's not advisable, but it can be done. And that might happen in his case. It certainly happened in the United States government's case, as debt becomes owed, they simply issue more debt to pay it, and thus we have this escalating national debt. It's not paid back; it's just refinanced, basically, when it's due. Corporations don't usually have that in mind. When they're paying off a loan particularly from investors in the form of a bond, they're going to pay them on the maturity date, on the day it's due. Corporations also can say to investors, look, we're going to put aside a certain amount of money every single year in order to pay this back. That's what a sinking fund is. It's just basically mean they've promised the lenders, the investors that loan the money, look, you can rest assured we're going to be paying you back because every single year we're going to put a little bit of money aside to help us pay this back all in one lump sum. Boom, sinking fund. Okay. So that's really a big thing about that. And this is how the chapter ends here with sort of a comparison of the long-term stuff. So equity financing is raising money from owners. That means issuing shares of common stock. That's how everything starts. There's no repayment. It's ownership. There's no repayment. Certainly, that's a big feature. If they need to raise more money in the future, they can issue more shares of common stock and raise money, or they can sell something called preferred stock, shares of ownership with no voting rights. Okay. But this usually happens after the fact. Everything starts with common stock, common shares. And again, the company, if they need to raise money over and over again, can simply sell more common shares to investors and raise money. So that's something. Some companies, like I say, when they need to go out and raise more money, they prefer to issue what's called preferred stock, no voting rights to these new owners. And what we looked at is debt financing here in the last piece. Long-term loans, again, long-term meaning 3 to 7 years in essence. A lot of these are bank loans or business-to-business loans over the short period of time. It's a little bit expensive for the company to do. So oftentimes they'll go and ask investors, hey, we're looking to borrow money. We could go to the bank, and they probably have gone to the bank, but they're often asking investors through the bond market for help as well. So again, if you're a large company and you're financially healthy, it's relatively easy to get investors to lend you money. These are long-term bonds. Like I said, this is interesting. It says usually 1 to 30 years, but I would say it's usually, the typical 10, 20 years is very typical. It certainly can go up to 30, certainly can be shorter than 10. But 10 to 20 is usually the typical corporate bond type of limit. And that's that.